Welcome to Insights. I'm Eric. I want to do a review of last week's labor report. Not really a breakdown of the labor report. I find that the labor reports or anything that's put out by the government is so heavily skewed that it's completely unreliable. Anyone who's followed me in the past and going back a long time, I used to delve into the statistics far more between the birth-death model and the different types of statistical techniques that they use to produce the number of seasonal adjustments, things of that nature. What I found is, and it comes up to an inevitable conclusion, that the data is just not reliable. Most data is so often skewed or revised when no one's looking that you really can't use it. You can't feed it to a computer and say, what do you think? Because the computer would be it'd be confused by the extent of the revisions that constantly take place, again, when nobody's looking. Last week's labor report, which I really don't even know what the expert thinks about it, because it's a lagging number and you shouldn't even be following it anyways. But it was either I've read between stronger than expected or worse than expected. It's going to endorse more stimulus through the current administration or otherwise, but it's whatever narrative they want to sell anyways. They can push around the numbers or sell it to people that will justify more debt and more spending. But the reality is that the non-farm payrolls was far weaker than advertised, mostly because, and I don't really put this in the matrix because, again, it's not particularly useful information. The EAC, which I'll pull that up quickly before I talk about the labor report. The EAC is down here. The economic activity posit and the different short-term and long-term oscillators use this. This is far more reliable. This is market-driven. The direction of this is either up or down. It's currently just barely up, which means there's a positive bias. But in reality, the labor report, it has nowhere, it's not even a part of this. But we're going to talk about the labor report here for a moment, because the labor report is it's so widely covered by mainstream media and everyone. And I mean, it comes out at the end of the month and everybody watches it like it's going to reveal something insightful to where the future direction of the U.S. economy is. And it's a lagging number to begin with. It's labor continues to deteriorate long after the economy turns higher. But what the computer picked up last week or on Friday was the extent of the revisions, and you can see some of them here within the data. I pulled some of it out of my master database, and it gets pulled in here. This series is non-farm payrolls, but when the computer looks at the difference between the months, there was a huge backwards revision of previous data and even last month's data. And what I've been reading and I've been hearing when I talk to people is that we will recover, the stimulus will get us back on track, and I would really caution against doing that. This is just the non-farm payrolls less the previous month, and then you sum it for an annual sum. And you can see that each crisis and each economic crisis or downturn that we have, that the labor situation is deteriorating rapidly. Normally a pullback or a contraction, which would see continuation of the labor deterioration well after the official bottom in the economy. But it was contained in a lower band, which means this is above zero. You're actually losing. This is job destruction above here, job creation up above. But anytime you had a recession prior to, say, 2002, everything was contained on the low side to roughly about this line right here. But after 2009, things started to deteriorate, and whether or not whoever you want to blame, you want to blame Trump, you want to blame Obama, I mean, you can blame whoever you want. The fact is the invisible hand can see what's going on here. There's a deterioration within the U.S. labor market and probably the global market. U.S. in particular, because it's the core economy and capital is moving away from the core economy into it's going to establish a new one. But I'm not really here to talk about that. We can talk about that some other time. The last impulse that we saw in job destruction was quite substantial in 2009. But we're seeing here in 2020, 2021, the job destruction is massive. And even as we've recovered here, we're still recovering at a lower low than 2009. It's possible that you could even roll over again, and we've done that before. In 80, 81, we broke below, jumped a little bit, and then we fell again. That could easily happen here where we fall again into 2022. But the fact is that this amount of job destruction is going to be difficult to recreate. Whether or not you believe it can be established or reestablished by forcing a higher minimum wage, it's as long as capital has and private sector has flexibility of thought and profitability, there's no way they're going to execute on it. You can force minimum wage up to $30 an hour if you want, but automation will take its place. We see it everywhere, from kiosks and fast food restaurants to self-checkout at the big box stores are everywhere. That was something that didn't exist much 20 years ago, but it's becoming prevalent. You don't have to pay you and I to check out our own groceries. We require no benefits, and we are not on the payroll. And if you're forcing $20, $30 minimum wage, it just means more people are going to be replaced by automation. And now with the advent of robotics and automated machinery, it'll just extend. If you walk into an Amazon warehouse, you're going to find that soon that place is populated by, I don't know, once 1,000 people, but maybe 100 as automation takes over. It's a trend that you can't win, and it's a trend that the computer is noticing as labor is being destroyed. It was destroyed in the initial breakdown from the COVID outbreak, but also the revisions that are taking place is causing a waterfall decline. It's serious stuff, of which nobody's really talking about it. The other thing that's you see a lot, and I'm going to click here, is that the household unemployment rate is, placed at 6.3%. I mean, it's much higher in depression, but the calculation methodology has changed dramatically since the 20s. I mean, they use all sorts of techniques to keep this number a lot lower. One of them, his favorite one, is to readjust for people who are no longer considered in the civilian labor force. There's ways to do this, but if you keep the less people say, well, he's no longer working, even though he's definitely within the working age and he's probably sitting home playing Nintendo, or whatever, just sitting home because there's nothing else to do. There's no jobs. The civilian labor force is going to shrink. So you have to keep the civilian labor force constant if you want to compare these ratios over time. But they're not doing that. They're adjusting it. There's ways to come up with a different unemployment rate, but that's not what they use when they talk about it in the headlines. Ultimately, the trends that are still in place, and I still don't talk about this much, is you have a service-based economy. That's by these two numbers here, and this is our manufacturing economy, and it's gone. And ultimately, if the service-based economy is attacked through either a global reallocation or automation or robotics, this number is going to have nowhere to go but down, and then there's going to be a whole generation of people who are going to be unemployed or will not have any skills in the next generation of the economy. Now, what they will choose to do, I have no idea. I can only see where the trends lie. If we continue downward, obviously we peaked around in here and we're making a rounding top and we're heading lower. Stimulus won't fix this because stimulus is just keeping people's heads above the water. So ultimately, it's like the labor report and some of these numbers, which you really don't see in the matrix. I'll keep an eye on them. When I see unusual things, I'll throw them out for everyone to look at. This is a common theme for the last 10 or 15 years easily. I don't suspect it's going to go away. If this rolls over again and we start to break down lower, I will post this chart and have another discussion, although I'm not sure anybody's really going to want to talk about it because it's not very friendly. I mean, it's like people are going to be hurting for work and people are going to be hurting everywhere you turn, and it's going to be a society that's going to have to lean on one another, and right now that's not what we're doing. So perhaps we should regain a new focus that says that everyone shares the same priorities. That doesn't mean everyone has to share everything. It's just that we share the same priorities within society. We have to make sure that society looks out for one another, and I don't think that these trends are telling us that it's going to get any better anytime soon. So, anyways, that's the setup for the U.S. economy. It's not really a review in a sorts, but it's something that you guys should be talking about amongst your family and your friends. And if I see anything unusual, I'll let you know. And other than that, we'll have a good trading week next week. And if you have any questions, contact me. Talk to you again.